Welcome to the deep dive. Today, we're sort of navigating the operational side of investment management.
Yeah, what goes on behind the curtain, so to speak.
Exactly. Think of this as your essential guide. We've sifted through a whole stack of sources to pull out the really key stuff.
Tailored for you, the learner, so you can get a handle on it without feeling, completely swamped.
Right. Our mission is to unpack the core mechanics, how investing actually works operationally.
And a good starting point is, well, who can actually invest?
Good question. Individuals,
Yeah,
obviously.
individuals are a huge part. You've got your resident folks, minors investing through guardians, HUFs, Hindu undivided families, NRIs, even foreign portfolio investors.
Okay.
But then there are institutional investors. Think financial institutions, pension funds, insurance companies, banks. And for them, the process is quite different, more formal.
More formal how? So it's not just like one manager deciding to buy a load of shares.
Oh, definitely not.
Yeah.
For an institution, it usually needs a green light from the board of directors.
Uh,
They have strict guidelines on asset allocation, where the money goes. Big focus on risk management, too.
Yep.
Expected returns.
Makes sense.
And then you need specific authorized people, signatories, to actually sign off on the paperwork. It's a much more layered, controlled thing compared to you or me investing.
Yeah, very deliberate. Okay, and back on the individual side, you mentioned different types, like NRIs, and I've heard of accredited investors.
Exactly. Regulations treat non-resident Indians or persons of Indian origin differently in some cases. And yes, accredited investors.
What defines them?
Basically, they meet certain financial thresholds. High net worth, significant income, or substantial assets under management.
Right.
The idea is they're considered more sophisticated,
Right.
may be able to understand and bear more risk, so they often get access to investment products that aren't available to the general public.
So like a different tier of investment opportunities.
You could put it that way, yeah, based
Yeah.
on their financial standing.
Mm.
But it's also key to remember that eligibility can depend on the specific investment product itself. The offer document for any scheme is crucial. It spells out exactly who can invest based on regulations from SEBI, RBI, and the specifics of that offer.
But generally, the pool is quite wide.
Very wide. Resident individuals, HUFs, minors through, guardians, societies, clubs, NRIs, PIOs, banks, companies, trusts, FPIs, insurance firms, pension funds, even other mutual funds.
Yeah.
Subject to the rules, of course.
All right, so we know who can invest. What's the very first practical step someone takes when they decide, okay, I'm investing?
The first hurdles are meeting the mandatory requirements. Some are regulatory, the big one being KYC, know your customer.
Verifying your identity.
Exactly. And others are specific to the product or service laid out in the terms of offer. Like if you're jumping into an IPO, a public issue of shares,
Yeah.
there's a set window, the subscription period, when you have to apply. You can't just do it any time.
And payment for those has changed, hasn't it? No more mailing checks?
Correct. Since early 2016, it's mandatory to use ASBA, application supported by blocked amount.
How does that work again?
You authorize your bank to block the application money in your account. Doesn't leave, just gets earmarked.
Okay.
Then, if you get allotted shares, the money is debited. If not, the block is simply removed. Much cleaner than the old refund system.
Way better. Less waiting around.
Definitely. And now, UPI, the instant payment system, has also been linked with ASBA for retail investors, making it even easier through intermediaries.
Nice. Technology helping out.
Absolutely. And all these details, eligibility, payment methods, investment limits, they're all in that offer document we mentioned.
The rule book for that specific investment.
Precisely. It tells you who qualifies, how much you can put in, minimums and maximums, and any restrictions, like NRIs usually can't use post office small savings schemes,
Right.
or some products might be only for pension funds, for example, or age limits on certain pension plans. It's all spelled out there.
Got it. So, check the offer document. Now, you mentioned KYC, and we know PAN is essential too. Let's dive into those regulatory must-haves.
Okay, let's start with PAN, the permanent account number, issued by the Income Tax Department.
The key ID for investing.
Pretty much. For almost all financial products in India, you need a PAN. Very few exceptions. Opening a demat account, investing in shares, even post office savings bank deposits or FDs over, say, 50,000 rupees usually require it.
Okay, PAN is fundamental. What about KYC? What's its main job?
KYC, know your customer. It's driven by the Prevention of Money Laundering Act, PMLA, from 2002. The core idea is identity verification.
To prevent dodgy money getting in.
Exactly. Prevent illicit funds entering the financial system. And it applies broadly: banking, mutual funds, insurance, depository services, the lot.
So what do you actually need to provide for KYC? What
It's
documents?
about proving who you are and where you live. So proof of identity with photo passport, driving license, voter ID, Aadhaar card are common.
Mm-hmm.
And proof of address, same documents often work. Or maybe a ration card, recent utility bills. And naturally, your PAN card is usually needed too.
Right. I've heard of KRAs, KYC registration agencies. What's the role?
Good point. For mutual fund investors, KRAs are central. They handle the whole process: collecting, verifying, storing your KYC info.
So you don't have to do it everywhere.
That's the aim. And eKYC, using your Aadhaar data through UIDAI, is a big part of that now. It's recognized, convenient. You just consent to let the intermediary access your UIDAI data.
Okay.
There's also something called PAN-exempt KYC for really small investments. Micro investments, they call them.
How small is that?
Up to 50,000 rupees total investment in a financial year, just for individuals. Instead of PAN, you get a special KYC acknowledgement letter from the KRA with a reference number.
Useful for smaller investors then. And tech is changing this whole KYC game, isn't it?
Massively.
Yeah.
Digital KYC is taking over. Things like e-sign for online document signing, using DigiLocker for submitting documents securely, online forms.
And video verification, VIPV.
Yes, video-based in-person verification. You do a live video call with an authorized official. Yeah, they ask questions. You might show your ID or the form on camera, maybe do an OTP verification. It's all recorded digitally. Secure way to do it remotely.
Sounds efficient. What about uniform KYC? Is that related to KRAs?
It is. Uniform KYC aims to stop investors having to repeat the whole KYC process every time they deal with a different entity in the securities market: mutual funds, DPs, brokers.
So do it once, use it multiple times.
That's the idea. Your KYC details get stored centrally by a centralized KYC registration agency, like CERSAI.
Okay.
When you do KYC with one intermediary, they upload it to CERSAI, and you get a unique KYC identifier. Then, if you go to another broker or fund house, they can just download your verified details using that identifier.
That must save a lot of hassle.
It does, though they might still ask for updates if info changes or need to verify your address again or do extra checks sometimes, but the core data is reused.
Great. Okay, KYC and PAN sorted, initial investment made. What's next operationally? What identifier do you get?
After that first investment, you get a unique ID number. Could be a folio number, account number, customer ID, certificate number. Depends on the investment type and institution.
And that's your reference for everything related to that investment.
Exactly. It links to all your key details. Name, signature specimen, address, bank account for payouts, PAN, your KYC status. And if an advisor was involved, your risk profile is usually linked too.
What if you invest with someone else? Jointly.
Joint holding is common, often up to 3 people, but sometimes just 2, like for some Bank of D's or the Senior Citizen Savings Scheme. NPS, the National Pension System, though, is always single name only.
Right.
For joint accounts, you need to specify the mode of operation. Is it jointly, meaning everyone has to sign, or either or survivor, where any one holder can operate it?
And does it matter whose name is first?
Yes, the first holder's name is usually the primary one for records, receiving payments, tax stuff. But all joint holders are officially on the account. If it's either a survivor, any one of them can typically request redemptions or make more investments.
So this folio or account number is like the master file for that investment. Can you add more money later using the same number?
Generally, yes. For things like NPS, RDs, post office schemes, mutual funds, you can make additional investments into the same account or folios. Just quote the existing number.
Okay.
With mutual funds, you can do lump sums or SIPs, systematic investment plans. And the good thing is, for these top-ups in the same folio, you often just need a simple transaction slip.
Minimal info needed.
Right. Your name, folio number, scheme name, transaction details. Usually no need to resubmit KYC or PAN proof, as it's already linked.
And for stocks and things in a DMAT account.
It's all consolidated there. All your buying, selling holdings tracked within that single DMAT account.
Sounds efficient. What if someone has old physical share certificates lying around? Can they be converted?
Ah, yes. That brings us to dematerialization and rematerialization.
DMAT and remat.
Exactly. We have depositories in India, NSDL, and CDSL that hold securities electronically. Dematerialization, or DMAT, is converting those physical paper certificates into electronic form.
Like digitizing a document. How's it done?
It involves you, your DP depository participant, who's your link to the depository, the company that issued the shares, or its R&Key agent, and the depository itself.
Okay, several players.
You submit the physical certificates, and a dematerialization request form, DRF, to your DP.
Right.
The DP sends an electronic request to the R&T agent and the depository. A unique DRN dematerialization request number is generated.
DRN. Got it.
The physical certificates in DRF then go to the R&T agent. They verify everything, the DP's authority, the DRN, the certificate's authenticity.
Checks and balances.
If all's good, they mark their certificates surrendered for dematerialization. In the company's main records, the register of members, the depository's name replaces yours for those shares.
So the depository holds them on your behalf?
Essentially, yes.
Yeah.
And importantly, no stamp duty is charged for demat-adding. Once confirmed, your demat account with your DP gets credited electronically, and the physical certificates, they get destroyed by the R&T agent.
To prevent misuse. Okay. What could cause a demat request to be rejected?
Various things. Mismatched info on the form versus company records, fake or stolen certificates, names not matching the demat account exactly, sent to the wrong company, or even a signature mismatch on the DRF.
Okay. So demat is paper to digital. What about going the other way? Rematerialization.
Remat, yes. Converting electronic holdings back into physical certificates.
Why would someone do that?
Less common now, but maybe for specific personal reasons or if required for a particular transaction, though that's rare.
How does remat work?
You submit a rematerialization request form, RRF, to your DP. They verify your signature and check you have enough electronic shares.
Huh?
The request goes electronically to the depository and then the R&T agent. The R&T agent verifies, creates a physical share folio, or uses an existing one, assigns certificate numbers, and updates the register of members back to your name.
And your electronic balance goes down.
Exactly. Your depository account is debited. Then the R&T agent prints the physical certificates and sends them to your registered address.
Understood. Demat and remat. Now, what if someone wants another person to manage their investments? Power of attorney, right.
Precisely. A power of attorney, or POA, is a legal document. You, the grantor, authorize someone else, the attorney or holder, to act for you on investment matters.
Who typically uses this?
Very common for NRIs living abroad who can't easily manage transactions in India. Also used by residents who want a broker or advisor to handle things.
Do both people need PAN and KYC?
Yes, both the grantor, you, and the attorney, the person you appoint, need to be PAN and KYC compliant.
What can the attorney actually do?
Generally, routine stuff. Buying, selling securities, making payments, requesting redemptions. But the exact powers depend on what the POA document says and the provider's policies.
Are there limits? Can they do everything?
Key limit.
Huh.
They usually can't make a nomination for you. That right stays with the investor. Also, even with a POA, you, the original holder, can usually still operate the account yourself if you want.
Okay. What makes a POA legally valid for investments?
Needs proper execution. Ideally typed on non-judicial stamp paper of the correct value for the state.
Stamped and signed.
Yes, duly stamped. Signed by the grantor on every page, and by both grantor and attorney on the last page. Often needs notarization too by a notary public, though requirements can vary a bit.
What if it's signed overseas?
Can be on plain paper initially, but usually needs attestation by an Indian embassy official or a foreign notary. Then it comes to India for the attorney's signature, stamping, and maybe notarization here.
Can minors grant a POA?
No, minors can't enter contracts, so they can't grant a POA.
And you need to submit it where it'll be used.
Yes, a certified copy goes to the bank, broker, or whoever needs to act on it. But note, a POA holder typically can't open or close bank or demat accounts for the grantor that usually needs the actual account holder.
Makes sense. Are there different types of POA, like different levels of power?
Broadly, yes. Two main types. General power of attorney gives very wide authority. Banking, tax, property, contracts, investments, almost everything.
When would you use that?
Maybe if you're going to be away a long time, or if health prevents managing affairs directly.
And the other type?
Specific or limited power of attorney. This grants authority only for clearly defined specific actions.
Like one particular trade.
Exactly. The document must spell out precisely what the attorney is allowed to do. You can tailor it very narrowly to the specific need.
Okay, general versus specific. Clear. Let's shift focus to non-resident Indians, NRIs. We touched on them, but what are the key operational differences for them investing in India?
Right. First, the definition of NRI under the Income Tax Act is based on days spent in India in a financial year. Less than 182 days usually makes you an NRI.
Uh-huh.
There's also a 60-day rule combined with time spent in previous years, but with exceptions for folks going abroad for work or PIOs visiting.
And PIO is person of Indian origin.
Yes, someone who held an Indian passport or parents, grandparents born in undivided India or married to an Indian citizen or PIO.
What's the biggest thing NRIs need to track for investments?
Repatriation is key. Can they take the money principal and returns back out of India easily?
And that depends on...
Where the original investment money came from. If it came from foreign currency via specific accounts like NRE, non-resident external, or FCNR, foreign currency non-resident, then generally, yes, it's freely repatriable.
Okay.
But if the investment was made using Indian rupees, maybe held in an NRO, non-resident ordinary account, it's generally non-repatriable. Capital account rules.
So you can't mix funds.
Not if you want the foreign-funded part to stay repatriable, no. Keep them separate. There's also a limit, currently USD 1 million a year, for repatriation from NRO accounts.
But no limit from NRE FCNR.
Generally no limit for NRA FCNR funds or investments documented with a foreign inward remittance certificate, FIRC, and income earned in India, like dividends or interest. That's freely repatriable after Indian taxes paid.
Crucial to track the source then. What about NRA KYC? Any extra docs needed?
Similar process, but yes, extra proof. Besides the usual ID, address, PAN, they need certified copies of their current passport, proof of overseas address, maybe a PIO card if applicable. Merchant Navy NRIs might need a mariner's declaration. Documents need to be in English and attested usually by an Indian consulate or an overseas branch of an Indian bank.
And they also do the Fat Caxures declaration.
Yes, since 2016, both residents and NRIs fill out the Fat Caxures self-declaration. It's about tax residency info for international compliance.
I remember hearing about PINS accounts for NRIs. What are those?
PIN's Portfolio Investment Scheme account. It's mandatory for NRIs POs who want to trade Indian-listed securities, like shares or mutual fund units, directly on the stock exchanges here.
So a special channel for stock market trading.
Exactly. All those stock exchange transactions must go through a designated PINs account with an authorized bank. The bank reports these trades to the RBI.
Can they have more than one?
An NRI can have one NRE PIS account for repatriable investments and one NRO PIS account for non-repatriable ones, opened at specific authorized bank branches.
What docs are needed for a PINS account?
Usually passport copy, visa work permit copy, PIO card if relevant, overseas address proof, plus the specific PINs application form.
Are there rules on what goes in and out of these PIS accounts?
Yes, specific permitted credits and debits, NRE PIS credits, can be foreign remittances or sale proceeds of repatriable shares. Debits can be for buying more securities or remitting income earned. There are also limits on how much of a company NRIs can own, typically 5% individually, 10% total, though companies can raise that aggregate to 24%.
And where do they hold the securities bought via PINS? Standard DAMIT.
Yes, NRIs open DAMIT accounts, but they must specify NRI status in the subtype. Repatriable, linked to NR, non-repatriable, linked to NRIs or NPS.
Separate accounts for each.
Generally required, yes. Opening the DAMIT itself might not need RBI permission, but credits debits often need authorization from the PIS bank.
Any trading restrictions for NRIs?
Usually can't trade currency or commodity derivatives. Short selling is typically prohibited too. And they need to submit original trade contract notes to their PIS bank branch promptly.
Lots of specifics for NRIs. Okay, switching gears. What about routine updates? Your address changes or name or residency status. How do you update investment records?
Keeping records accurate is vital. For address or contact changes in the capital market world MFs, deem it the key is updating your central KYC record with a KRA.
Not just telling the fund house or broker.
Usually not enough anymore. You need to use the KRA change process, submit the form, self-attest to do address proof. Once the KRA updates, everyone else can access it.
And for other things like bank accounts, insurance.
For those, you generally inform the specific provider directly, following their procedure, providing address proof.
What if your name changes? Marriage, for example.
You need to formally request the change with each provider. Send a letter with supporting legal proof, name change certificate, official Gazette notice, or marriage certificate.
Specific forms needed sometimes.
Yes, maybe an NPS S2 form or a KRA change form for KYC. Might need notarized copies of the proof too.
And changing residency status. Resident to NRI or back. That sounds complex.
It is significant. It impacts bank accounts, taxes, KYC. Going from resident to NRI means telling your bank to redesignate accounts to NRO.
Hmm.
You'll need new NRI DMAT and trading accounts, transfer holdings, usually not repatriable then. Inform all providers, update KRA with overseas details.
An NRI back to resident.
Inform bank, close NRE accounts, open resident accounts, maybe an RFC account for foreign currency, get new resident DMAT trading accounts, transfer holdings, inform AMCs, update KRA again with Indian details. Small savings schemes might have specific rules too.
Definitely processes to follow carefully. What about pledging investments for a loan marking a lien?
Right, using investments as collateral. You and the lender inform the investment holder DP for shares, AMC for MS. There's often a specific form.
What info is needed?
Folio account details, scheme name, number of unit securities being pledged, and the lender's, lien holder's details.
And then what happens?
The lien gets recorded. Your statement will show those units are under lien. You generally can't sell or redeem them without the lender's okay.
Do you still get dividends?
Usually, yes, dividends or interest still come to you, the investor,
Yeah.
unless agreed otherwise. Once the loan is repaid, the lender sends a request to remove the lien, unmark it.
And if you default?
The lender can invoke the lien, meaning they can sell the pledged assets to recover the loan amount.
Clear. Now, the difficult topic. What happens when an investor passes away? Transmission of assets.
Yes, transmission, transferring ownership to beneficiaries. The process depends on how the account was held and if there was a nomination.
How so?
Joint account, no nomination. Usually goes to surviving joint holders. Joint account with nomination. Survivor rights generally trump the nominee. Single account with nomination goes to the nominee. Single account, no nomination, goes to legal heirs who need to provide legal proof, like a succession certificate.
What about HUF investments?
On the Carta's death, usually transmitted to the new Carta. Providers try to be sensitive, might simplify things for smaller amounts. There are often thresholds for simplified documentation, maybe 5 lakhs for physical shares, 15 lakhs for DMAT.
And once paid out to the nominee or claimant?
The investment entity is usually discharged from further responsibility for those assets.
What documents are typically needed for transmission?
The death certificate is essential. Then, depending on the situation, maybe probate of will, succession certificate, proof of relationship, indemnity bond, NOC from other heirs, claimant's bank KYC details, possibly an affidavit.
You mentioned nomination simplifies things. Can we revisit that?
Absolutely. Nomination lets you designate who gets the investment benefits upon your death. You can do it when investing or later.
Does it cover everything in an account?
Usually, yes. Applies to all holdings in that specific folio or account. Many products allow multiple nominees with percentage shares. It's actually mandatory now for single-held mutual funds and DMAT accounts. Highly recommended otherwise.
Can you change it?
Yes, anytime. But if it's a joint account, all holders must sign the change request. POA holders generally can't make nominations.
Any recent changes to nomination rules?
Yes, effective March 1st, 2025. Key points. Survivorship rules clarified for joint accounts. If all joint holders die simultaneously, it goes to the nominee. Online or offline nomination submission is allowed.
Anything else?
Crucially, you now must provide a personal identifier for each nominee, PAN, driving license number, or last 4 Aadhaar digits, just the number, plus full contact details, relationship, date of birth, if minor. And you can have up to 10 nominees now per account.
Good updates. What about assignment? Especially for insurance. Sounds different.
It is different. Assignment is transferring your rights in a property or contract. With insurance, you might assign your policy benefits to a lender as loan security. That's usually an absolute assignment. There are also conditional assignments. It's done via form or endorsement registered with the insurance company.
Okay. Let's quickly touch on special investor categories again. Minors, NRIs, covered a lot, and those using a POA. Any extra operational points for minors specifically?
Right. Minors can't contract, so investments are always via a guardian. Application needs minor's date of birth, guardian's details, relationship, guardian's PAN.
Joint holding rules.
Only joint holding allowed is between the minor and the guardian. Guardian must do KYC. PAN needed could be minors, guardians, or both, depending.
What if the guardian changes?
Needs a formal request, supporting docs like consent court order, death certificate if applicable, new guardian's KYC, and bank signature proof.
And when the minor turns 18, becomes a major.
Big step operationally. Transactions in the minor account usually stop until their status is updated.
What do they need to do?
The now major needs to do KYC as an adult, maybe personal verification. attest their signature with the bank, get a new PAN card with their signature, redo the demat account opening process as an adult, transfer securities from the old minor account. Notify mutual fund registrars too, with bankers' attestation of their signature. And any running SIPs usually get suspended until this status change is complete.
Okay. And we covered NRI status changes earlier. What about simpler things like adding or removing a name on a bank account?
Bank accounts are usually straightforward. Joint application, new person provides KYC, if being added, signature card updated.
Mutual funds.
Adding a name to an existing MF folio generally isn't allowed treated like a transfer. Usually need to open a new folio with the desired holders and transfer units. Deleting a name needs requests from remaining holders.
And changing the linked bank account for payouts? Bank mandate changes.
Usually involves a specific form submitted to the provider. For MFs, it's a change of bank mandate form, signed by all holders, often needing a canceled check or a statement copy of the new account.
Trading accounts might allow multiple?
Yes, trading accounts might let you link several banks. Mutual funds also often let you register multiple bank accounts for folio, designating one as primary for payouts. Process varies slightly by provider.
Got it. So we've covered a lot on account admin. How do people actually pay for investments? What modes are common?
Wide range. Traditional, local or at-par checks, demand drafts, post-dated checks, mainly for SESIs.
And digital.
Lots now. And ACH for recurring debits like SAPs, RTGS and FT for electronic bank transfers, standing instructions, ASBA for IPOs, NFOs.
Cash allowed at all.
Limited cases. Some post office schemes, insurance premiums. For mutual funds, up to 50,000 rupees per investor, per fund house, per year, with strict PMLA compliance.
And the rule about payment source for capital
A
market.
crucial point. Payment must come from the first holder's bank account. Helps prevent money laundering. Ensures clear fund trail.
So no third-party checks generally.
Generally, no. Especially for initial investments, electronic modes are preferred over checks now. Demand drafts might be used if no local collection center exists. SIPs use post-gated checks or ACH mandates.
Can you recap the main digital payment systems quickly?
Sure. ACH Automated Clearinghouse for recurring debits. ASBA blocks funds for IPOs and NFOs, debits only on allotment. Internet banking transfers. Debit card payments via provider websites.
And EFT-RTGS.
RBI systems for bank-to-bank transfers. Need recipient's account number and IFSC code. RTGS for larger amounts, 2 lakh plus. NEFT no minimum. NFT batch processed, RTGS real-time. Charges apply. Can often do it via bank branch form too.
Other digital methods.
UPI, AEPS, Aadhaar payments, USSD mobile banking, e-wallets are also increasingly used.
And you mentioned the PMLA rules on cash for MS Max 50K per year. Compliance needed.
And importantly, any repayments like redemptions or dividends must go back via banking channels only.
What about those exceptions to the no third-party payment rule for mutual funds?
Right. Limited exceptions. Grandparents, parents for a minor, up to 50K. Employers via payroll for employee schemes. Custodians for FPIs.
They need extra paperwork.
Yes, requires a specific third-party declaration form, and the payer must also be KYC PAN compliant. All these rules aim to prevent fraud, ensure funds are traceable.
Makes sense. All this complexity highlights why proper documentation is vital, especially when getting investment advice.
Absolutely. Documentation protects both advisor and client, prevents misunderstandings, ensures suitable advice. SEBI's investment advisor regulations are key here.
What's the main document?
The Mandatory Investment Advisory Agreement. It outlines roles, responsibilities, scope, fees, good faith clause. Both parties need a signed copy.
What else must the advisor document?
Collecting client info, age, income, assets, liabilities, goals, and verifying it. Conducting risk profiling using questionnaires, making sure the client understands, communicating the profile back.
And the advice itself?
Yes, documenting the process of shortlisting products, performance, strategy, risks considered. Documenting why specific products are recommended, linking them to client goals and risk profile, explaining features and risks clearly.
Recording the actual advice given too.
Yes, recording the advice, ensuring client understanding, noting any pre-investment requirements like KYC or specific accounts needed, and keeping all these records proofs, statements, for at least 5 years, physically or digitally signed.
What about MITC and advisory agreements? Most important terms and conditions.
Yes, SEBI mandates MITC for transparency. It's a clear summary of critical terms.
Like what?
Things like, advisor only takes fees, never client fund securities, no return guarantees, all investments have risk. Assured return schemes are banned. SEBI purview is mainly securities advice.
What about trades and fees?
Advisor can't trade without explicit client consent per trade. Fee limits, as per SEBI ASB rules. Advance fees capped, max 2 quarters currently. Proportionate refund on early termination, less maybe a breakage fee.
Payment modes.
Permitted modes listed. Check online, UPI, no cash. Option for centralized fee collection mentioned. Client needs to share financial info. Mandatory risk profiling and suitability.
Conflicts of interest. Distribution.
The advisor group can't do distribution for advisory client's family. Advice on direct plans where available. Prompt disclosure of conflicts is required.
Grievance redressal.
Steps outlined. Advisor DAC SEBI scores that smart ODR. Disclaimer that SEBI registration doesn't guarantee performance. Client must keep contact details updated. Advisor never asks for logins OTPs.
Very comprehensive set of protections. Okay, final topic. Investing in mutual funds via the stock exchange platform. How does that work?
It's an alternative route. Good for those used to stock trading similar interface for orders. Units usually go into your DMAT account.
But you're still buying from the AMC.
Yes, ultimately the purchase or redemption is with the AMC. The stock exchange platform just facilitates the transaction.
So the exchange acts as an intermediary.
Exactly.
Yeah.
AMFI registered distributors can use exchange platforms like BSE Star MF or NSE NMF2. The exchange's clearing corporation handles the money unit flow, reducing counterparty risk.
Can you do SIPs and stuff this way?
Yes, these platforms usually support SIP, STP, SWP switches alongside lump sum buy-sell. You can choose DMAT or physical holding, though online reduces paperwork.
How do advisors fit in here?
They guide clients on using these platforms, might suggest it for convenience. A big plus for advisors is the consolidated transaction feed.
What's that?
It gives the advisor a single view of all client MF portfolios and transactions done via the platform. Makes tracking and management much easier. Can often generate portfolio statements, club family accounts.
Can you update details through the platform?
Often, yes. Non-financial changes like contact info or bank mandates can sometimes be done via the platform. Overall, it offers less paperwork, potentially better service, transparency, and easy payment options.
This has been incredibly thorough. A real deep dive into the engine room of investing. We've covered investor eligibility, onboarding, PAN, KYC, DMAT, REMAT, POAs, NRIs, account maintenance, payments, advice documentation, and MFs via exchanges.
Quite the journey through the operational nuts and bolts.
Hopefully this gives you, our learner, real clarity and valuable insights into how it all works behind the scenes.
And maybe a final thought to ponder. How is all this increasing digitalization changing things? Think about the evolving investor experience, the role of intermediaries.
What new efficiencies, or maybe even challenges, might we see in the next few years as tech continues to reshape investing? Something to think about.
Absolutely. We hope this deep dive has given you a solid foundation to explore further.